When we talk about ordinary equity valuation or share valuation, we have three valuation approaches. The first one is called dividend discount model, and from its name, discount, it means present value. Dividend is we need to get the present value of future dividends. Therefore, in this model, what we need to do is we need to get the present value of all future dividends. The second model is called capital asset pricing model, CAPM, and with this one, our formula is risk-free rate plus market risk premium or equity risk premium. The third approach, which is less common, is called bond yield plus risk premium. So in this formula, what we need to get is, we need to get our before tax cost of debt. If we have bond, it will be our yield to maturity, before tax yield to maturity, plus required risk premium. And this required risk premium is usually between 3 to 5%. And it's subjective, and that's why the third approach here is less common. So for dividend discount model, we need to use the perpetuity formula, which is the price of a share today is equal to the dividend per share after 1 year divided by I, which is the cost of equity minus G. So can we rearrange this formula to put I in one side, all other variables in the other side? Yes. So here our cost of equity, which is RE or I, is equal to the dividend at year 1 divided by the price at year 0 plus G. It could be a period. It shouldn't be a year. It could be every year or every 6 months or whatever the period is. So remember here, there must be one period difference. D1 divided by P0 plus G. G refers to the growth rate, or it refers to capital gain. Do you remember when we talked about the difference between our income return and capital return? D1 divided by P0 refers to income return or dividend yield. G refers to capital return. For capital asset pricing model, the formula is our cost of equity is equal to risk-free rate plus beta, which is a measure of systematic risk, multiplied by open bracket, market return minus risk-free rate, close bracket. The third approach, which is bond yield plus risk premium, is our cost of equity is equal to the cost of debt before tax cost of debt or bond yield or yield to maturity plus our risk premium.